Okay, welcome to the 2020 Master Trader Program Super Performance Workshop with Mark Minervini. I'm Bob Weissman. Today is a live session of the question and answer session, part 2. As I updated the itinerary, sent you all an email, so do make sure you check your email boxes as well as perhaps your spam folder in case it does end up there. But this will be recorded and replayed tomorrow morning, 10:30 a.m. Eastern Standard Time. So we are having both time sessions, time zones, if you will, being able to partake in the Q&A session for part 1 already played, as well as now part 2. All the questions have already been submitted, so Mark does already have his list of questions for this evening. Do not type any new questions into the chat box today. You will still have an opportunity for asking questions on Monday during the live trading day, so do bear that in mind. But I can assure you, with how many questions Mark has prepared, in addition to what he already answered tonight as well, it is certainly sure to cover most of your questions, even if you didn't write it in yourself. With that said, this is scheduled to be about 2 hours. Mark will determine if we're going to be taking any kind of break, but right now it's scheduled to be for a 2-hour session from 6 to 8. And if again,
an hour and 30 minutes to 2 hours, not sure.
Okay,
yet.
sorry.
Somewhere in that neighborhood, yeah.
Mark did go over last time. He went almost to 3 hours last time. So he did answer a lot of the questions we had in advance from before. But I will also share, if you do have any type of video or audio issues, we've had a very, very few so far. Just log off, log back on again. That has corrected the problem in virtually every case. And again, this is being recorded, which would be available for a replay tomorrow, 10:30 Eastern Time. Check your emails, though, in case there are any additional updates and changes. But otherwise, Saturday morning, 9 a.m., will be the next live event that we'll be doing for day 3 of the Master Trader Program. And we will see you there at that time. With that said, let's get started with tonight's question and answer session. Mark?
Okay, so let's make sure we're recording here. And okay, so I just wanted to first welcome everyone. We have representation from, I think, over 50 countries. So that's there's people up all around the world at various time zones. So a lot of dedication there. Also wanted to, real quick, just let me just get my, there we go. Wanted to give a congratulations to, we've been watching the U.S. Investing Championship all year. And each month, of course, we watch the numbers come out, and they've been building and building to some really impressive numbers here. We've got the top out of the top 10. 6 out of the top 10 are Minervini private access clients, and you can see we have 3 of them are up triple digits, 205%, 200, 143, and of course our own Ralph Koppel, who we had an interview with Ralph a while back. He's tacked on, I think, another 17% since then. So looking pretty good here. And again, I think out of what do we got here? 8 of them out of the top 17. So we've been really having a good representation. Of course, last year, one of our clients, Leif Sorid, he won. So we're hoping that one of you guys in 4th, 5th, 6th, you can, or even someone maybe who is in 8th or 10th can move up here and take out Thomas there and Matthew there, who have some pretty big returns. But I know they've been sitting sort of at the same number here for a couple of months now, or at least a month or two. So maybe they're pulling back here and protecting their gains, give you a chance to catch up. Just to let you know, I mean, I was way behind in the U.S. Investing Championship when I competed in it, and I ended up winning and going to the home stretch. And so it's not over. You still have the rest of this month in December. Okay, so that's that. Let me also see here. So David Ryan I had to go to an appointment because we added this Thursday at last minute, and he's going to be joining us probably momentarily, or not too long. But we have a special guest. Our own Mark Ritchie is going to be here. Those of you who don't know Mark, I know a lot of you do, especially if you're a Minervini Private Access member. But those of you who don't, if you read Momentum Masters, he's in the book Momentum Masters, and a great great super trader, doing great this year. He's up, I don't know what he's up now, but close to a couple 100%. And that's with some real money. He's up several $1 million, I think almost $3 million this year. So he's doing great. He's been doing great since he came to the very first Master Trader program 10 or 11 years ago. Mark, are you there?
I am. You're flattering me. Thank you. Greetings, everybody.
Well, it's all true. If you got it, flaunt it. If you don't want to, I'll flaunt it for you. So anyway, so Mark's here. He's going to answer some questions with me. Those of you who know Mark from Q&A on Mondays for MPA. So let's get right to it, and let's take a look here. So we have the slide numbers. A lot of you have given us the slides to also reference, so that's really helpful. I also, just to tell you, my allergies have kicked up. We turned the heat on in the house, and all the dust, I guess, came out of something, and I'm just completely stuffed up and sneezing my brains out. So I'm sneezing in between, and that might happen. So on this slide 10, how do you identify the market turning up for good? Is that in this example, you started buying Amgen when the market bottomed. So, okay, so the thing is that you don't know when the market's going to turn up for good. And I think that's the point that I was trying to make when we talked about comparing the stocks to the general market. And if you remember, we talked about predictive and coincident, and then confirming, stock moves. And so you have to, for instance, just take a look here. Let me get my pointer here. Hold on. I got to get my controls. That spotlight. That's what everybody seems to like. So look right here. The market comes off, right? And starts rallying. And you can see that you had a little wedging cheat area, maybe not the greatest cheat area, but this stock set up right here, tightened up. It's breaking out into new high ground. And then the market rolls over and goes into the big part of the bear market decline. And that just pauses the stock out. So you might have even been buying it here. And again, if you bought it here, right, you buy it here and you're entering a bear market, you wouldn't even have had your stop challenged, not for 1 second. There was no pressure except this one day came back, had a good close, but you wouldn't have been stopped out, and you would have had a nice gain going into the bottom. So again, this is how you want to let the stocks guide you, because you don't know when the market's going to turn up. You have no idea. Mark, as far as looking at, let's say we're in a correction, and this goes back to, let's talk about this most recent mother of slides, in 2020, when we had the COVID situation. Well, we still have the COVID situation, but when it first broke and the market just, got annihilated. So what got us, because we were both getting into the market around the same time, what gets you back into the market? Are we looking at, tea leaves and all the indexes and trying to figure out when they bottom, or, what actually gets you back into stocks?
Yeah, it's the same thing every time. You see some accumulation in the market, and then I think I like David Ryan's quote. You make a few mental health buys. You test the water. These are weeklies, are they not, Mark? On these charts, because it even looks here where you're buying Amgen. This looks like 4 or 5 weeks off the bottom.
Yeah. This is a weekly. I'm sorry, I said day, but it is a weekly.
Well, but when you're 4 weeks off a bottom, odds are there's at least a follow-through day or two in there. You should be looking for what are the first names to emerge. So this is it's classic.
Right. Yeah, absolutely. Maybe you have the follow-through day, but Mark, let's say you don't have the follow-through day. You don't have the follow-through day. And even before you start turning up, you're coming off here on the market. If there's a whole bunch of stocks setting up and the market's in a downtrend, and you see stock after stock setting up and breaking out, are you going to just wait to get some signs that the market's bottom from the index, or are the stocks going to get you into a few of those names?
No, yeah. Well, there have been times where I'm fully long before the market bottoms. Those are rare, but no, I follow the stocks, of course.
Yes. There's been many times where I've been fully long before the market's bottom too.
This year is a perfect example though. And, this was 3 or 4 months ago, Mark, where we were both talking and you said, there's just stocks everywhere, just stock, it was June or something like that. And you're like, listen, It doesn't matter how far the markets run. Who cares what the indexes are doing? There's just stocks set up all over the place. Just keep buying them.
Yeah, I was talking to Mark, and he was like, "Do you think maybe we went a little far here, and maybe we're going to correct?" I said, "Who knows?" But there's so many stocks setting up. We're going to buy them. We're going to buy them, and we're going to buy them until they stop working. And that was the best run. That was our
Yeah, we had
best
a
run.
monster run. Yeah.
Yeah, we had a monster run from there. All right, let's move on to another one. Let's see. So page 17. Uh, question is institutional favorite Cisco. Why is it identified as a crowded late stage base? So let's define what a crowded trade, for instance. A crowded trade just means that there's a lot of eyes on it. It's popular. Maybe even like Zoom is probably a crowded name right now because so many people know it now. It's become so popular. So when you get a crowded trade, when you get a trade that all the eyes are on it, it could not work as well. You might have more random price action, more shakeouts, simply because there's just a lot of there's a lot of eyes on it, and it's getting popularized. And also, if institutions, if you have a leader that's been a leader for a long period of time, and it's come after base after base after base. So we're going to get into this later on in base counting and sell rules. But you get that late stage move in a stage two. Now you're getting to where institutions, there's so many institutions in it now that there's only really a supply. There's the real risk is to the downside. When are these institutions going to start unloading? So you can go and you can take a look at MarketSmith and take a look at the number of institutions. You look at something like an Apple. There's probably 6,000, 8,000, 9,000 institutions that own. We're talking about thousands and thousands of institutions. Just a few big institutions can break a stock. You get Fidelity start selling big and selling down a stock, they can really put a hurting on a stock pretty quick. So that's a lot of supply, as opposed to maybe some new issue, recent IPO that trades 400,000 or 500,000 shares a day. It's got 7 million shares in the float, and it's got 15 institutions that own it. So that's what we mean by a crowded trade. Let's see here. So page 21. I don't know why 21 would be referenced here, but what if the stock is looking great on a 52-week period? However, it's still 50% below its 2-year. There it goes. Sorry. It's still 50% below its 2-year or 5-year high. Should we ignore such charts? Okay, for example, commodity stocks. So that depends. I don't like hypothetical questions, and it really depends on the situation. But hold on one second here. Let's hope I don't go into a sneezing fit. An all-time high would be the best. If you're hitting an all-time high, all things being equal, if you're not in a late stage where it's coming off a 5th stage base, and the stock is extended, but let's just say you're coming off of a 1st or 2nd base within an uptrend, I'd love to see an all-time high. That would be the best situation because there's no supply at all. But if you have a stock that maybe previously, several years back, was a lot higher, but it's hitting a 52-week high. Yeah, that's fine. That's fine. We're looking, when we say a new high, we're talking about the 52-week high list. And then you've got to look at the chart. You've got to look to the left. You got to see how far back the supply is, and you have to analyze the chart and do some price and volume analysis. And that's where, again, you have to use your own good old fashioned roll up your sleeves analysis. Let's see here. And again, Mark, at any time, if you want to chime in, feel free.
Well, I would just say in general, you've talked about this probably, but the commodity plays traditionally are not your best plays. I know a lot of people like to play commodities, but in terms of they don't fall in those classic growth groups.
Yeah, that's true. And again, I'm very seldom in the commodity stocks and the gold stocks and papers and steels. I'm not in them too often. On rare occasion, and I have to say, going back through my whole career, I've certainly made the least amount of money in those. There's been times I called the bottom in gold in the mid 90s, and I had a really great move in gold stocks. There's been some times this particular stock, this Encore Wire, was an exception, but the grand majority of the time I'm in the growth names, the biotechs, the really the higher octane growth names that really can earn money or have some real breakthrough technologies. Let's see. So we're just moving to just one page to 22. Can you recommend a back testing tool? No, absolutely not. And I would discourage back testing in any way, shape, or form. I want to make sure everybody understands what I do, what David does, what even O'Neill has done, and you go all the way back to Richard Love. You may think that that's back testing. When we say 99% of stocks that were big winners were above their 200-day, that's not back testing. That's called factor modeling. There's a huge difference. Back testing basically goes and says, okay, well, let's try every moving average and see which one would have got us a nice return. Let's analyze all these different indicators and find out which one would have given the best return. What we're doing is the exact opposite. We're saying, let's look at all the biggest winning stocks and find out if they had anything in common. They may not have anything in common, but lo and behold, they do. Okay, big difference. It's like, imagine if you were to go and take all the Olympic athletes and say, let's see if there's anything in common, what they eat in their diet or their exercise regimen or how they think. And then you find out that, wow, 95% of these Olympic athletes take omega oils. All right, whatever. I'm just, or they, they're positive thinkers. They practice X amount of hours per day. Now you're starting to hone in on what makes a champion, right? Not just go and try to find any old thing, and that's how we've come up with the football indicators and all these crazy, stupid things that are absurd. But so, no, I wouldn't do any back testing. We've done all the testing. You don't really have to do a whole lot of back testing at this point. You just have to learn to execute. So actually that was, they're both slide 22. So when looking for stocks with under 30 million shares outstanding, is there a minimum average daily volume or dollar volume? So I wouldn't just necessarily look at for stocks. I hope you don't misinterpret this and think that I look at for stocks with under 30 million shares outstanding. That's not the case. It doesn't matter how many shares the stock has outstanding. I'm probably going to trade it if it sets up properly. However, all things being equal, a smaller stock has more explosive potential. It doesn't mean, though, that smaller stock will beat a larger stock. In recent years, mega caps have been in favor and they've made big moves, right? So, but to answer your question, as far as, average volume, I'll trade stocks that trade as little as 50 or 100,000 shares a day all the time. It's just I'm going to take a much smaller position. So you just have to position size. And generally speaking, the general rule is 10% of average volume of that. You wouldn't want to trade much more than that. All right. So page 24, what does capital intensive mean? Capital intensive just means it takes a lot of money. It takes a lot of capital. The average person couldn't start an airline, right? I mean, that would take an awful lot of money. But you could start a software company probably pretty easily. So, that's what capital intensive just means. It takes a tremendous amount of capital. Let's see. Minimum length of time, page 38. Minimum length of time in a stage 2 uptrend. Well, there is no minimum length of time. Once you meet the criteria, you're in a stage 2 uptrend. So right at that point, the second that you're in a stage 2 uptrend, that's when the stock is available for purchase if it meets the criteria to have a VCP and a good consolidation. And it meets all the criteria. So there is no minimum time. Now, for confirmed, if you're asking as far as what is the parameters of the stage 2 uptrend, yeah, it's 4 to 5 months with the 200-day and an uptrend, and above the 200-day is a confirmed stage 2. And an early turn would be just 1 month. 1 month, you're 200 days in an uptrend for 1 month. You're above it for a minimum of 1 month, and that's what I refer to as an early turn. Anywhere between 1 month and 4 months is an early turn. Let's see. So page 44. So aren't you buying in stage 1 before the beginning of stage 2? No, not at all. I don't know how you could possibly ascertain that, but again, just looking at this chart, you're not going to see all the criteria, but you can see that the longer term moving average here is in an uptrend. And the stock is in an uptrend. So, I mean, it's clear to me that it's in a stage 2 uptrend, but I can see how you could think maybe with this limited amount of information that it's moving sideways, but you're clearly in an uptrend. And as soon as it meets those 8 criteria, that's it. You're in stage 2 uptrend. Let's see. All right. So if after page 53, Okay, no, here are the 8 criteria. So that's perfect. If after buying a stock, a few days, if few days trend template criteria isn't there in the stock and the stock has not hit your stop loss yet, should we hold the stock? So basically saying that if you buy a stock and then it stops meeting the trend criteria, it stops meeting that criteria, but your stop hasn't been hit. Okay, first of all, that's not going to happen. All right, that's not going to. You're not going to have the stock go out of a stage 2 uptrend before it hits your stop, unless you're using a pretty big stop. That's just not going to happen. So the answer would be, yeah, that wouldn't be good if it morphed into a stage, 4 decline, but you would be stopped out. So that scenario is not even going to happen. Okay, so we're going to deal with this on Monday. And so do you use the trend template to filter potential stocks and then eyeball to find out the stock with a VCP? Yeah, we'll show you that on Monday, actually, on how we do that. We're gonna look at MarketSmith and do some screening and things like that. Okay, so page 54. Can you elaborate more about what market condition that the 3 different templates should be used? So all market conditions. There's no market condition that you should be using one over the other. I would be using them all, or certainly the 5-month wise if you want to put some other parameters. But the 1 month and the 5 month you should run, pretty much every day or every week through all market conditions. Let's see here. Just move down here. Okay, I defined an early turn. So what is a positive surprise model? Page 61. So positive surprise models are just simply computer models that pick up earning surprises. And those will, it's just if you were to screen for earning surprises and you'll get those stocks to come up. And also estimates revised up. You can run screens for estimate revisions and things like that. And that's what a lot of quant funds will run. They'll run these screens and use regression analysis. And when you get a breakout, that's why a breakout year is important. When you get that those earnings break out of that range, that'll start attracting some of those investors. It'll get their attention that something's happening. Wall Street likes change, positive change, and negative change, of course, would be what they don't like if you're owning a stock. So coming in better than expected, having a surprise is an important thing in the stock market for attracting institutional investors. Okay, so page 73. Let's see. I wish there was more questions I can get you involved in, Mark. But we're kind of just going.
No, doing fine.
Yeah. Let's see here. So are these year-over-year basis? Heading is quarterly earnings acceleration. Okay. So let's sum this up. So this is a year-over-year. So this 83% would be comparing this quarter to the previous year's quarter. So if this is 2020, you're going to be comparing quarter 3 to 2019. And then same thing with Q2, would be comparing it to Q2 of 2019. And then you're looking for, this is called sequential acceleration. So you would have year over year changes, and then you would look for sequential acceleration based on year over year changes. All right, let me, I think this one I'm going to keep for David. I think I see a few here that are good. Some are actually for David.
Hey, Mark, I'm back.
Hey, there he is. Okay, good. Let's all 3 of us stay on. Okay. So yeah, let's stay on, Mark, and we'll all take cracks at these. So
just real quick, guys, if you could do a sound check, raise your hand if you're hearing David Ryan also. Thank you.
Yeah. It's nice to join this call.
Dave, nice to have you back. Nice to have you back. Did you go to the dentist?
No, I had an eye doctor appointment.
Oh, eye doctor. That's right. Okay.
Yeah, this is an eye doctor. It takes 2 months to see this guy.
Oh yeah, can't cancel that. No. All right, good. Well, I'm glad you're here, and you didn't miss much. We're so on page. I'll go back here to page 8, and let me give you this question. And then Mark, you could even comment on this. When money starts moving into laggard stocks in a strong group, it may be an indication of the bulls on its last leg. Let's see. It's a big question, so I gotta. Is it also a red flag, and can it be a genuine case of sector rotation because of the change of prospects? I'm not sure exactly. So I guess the question is, if money, moving into laggards, is that an indication that you're getting late? And the other question here, there's two questions, so I grouped them together. The other question is, do you trade the laggards? Is there a time where, the leaders may be top, and I said that leaders, lead and they top, but then do you not trade anything? What if laggard stocks start coming out of bases? So those are the two questions. You could take a crack at that first, Dave.
Yeah, well, it's not that often where there aren't any growth stocks that aren't making you money in the market, and when there aren't, it's usually in a bear market. But I have seen times, and it can be very, very frustrating. And I can refer to, we're going way back, where the huge bull market starting in August of 1982 had this huge move, great move, lasted 9 months. Things just exploded. There were growth stocks all over the place. But then those took a time off. And from probably about June of 1983 to sometime in 1984, it was just laggard stocks, cyclical stocks, and it was very, very hard to make money in the type of stocks that we're talking about all the time. So there are times where it can be very frustrating. Now, to move into laggards, well, you start doing that, then you're going to start doing what they call a style drift, and you start looking for other areas. Well, that might work for a little bit, but it might also lead you into some very bad habits, and then you lose your discipline, and you're starting to look for anything that sets up. So I would be careful if you did it. Maybe you did it with if you were looking for more cyclicals, maybe you do it with a small amount of your money, but you just don't want to drift too far away from what we've found makes you the most amount of money in the shortest period of time.
Yeah, Mark, you're very disciplined, and you're like me. You'll wait and wait and wait and stalk and stalk and stalk for the right moment. But you also are very opportunistic. You're gonna be as creative as possible if there's something to trade. So I don't even know how we can define a laggard as far as really giving it fully quantifying it, but I guess if there's stocks setting up in bases, I'm trying to trade them, and I'm looking for that theme. If it's working, great. But as far as trading laggards, and when I would say laggards, like low relative strength stocks that are really stocks that you wouldn't trade anyway. Are you ever saying, okay, there's nothing to trade, so I'm going to try to trade stuff that I really shouldn't be trading, or that doesn't meet the criteria?
No, well, certainly nothing that doesn't meet the criteria. And the reality is, it's a laggard for a reason. Why is it lagging? Even recently, we've had you'll have these 2-3 day moves where stuff like hotels or cruise lines will start moving, and we've had people saying, well, why don't we trade this stuff? It's like, well, because one, they don't meet the criteria, the setups aren't that good, and the moves are highly failure prone. So it just doesn't pay. You're better off just waiting for those. Why even mess around with it if you're going to miss opportunities in those number 1 and 2, the market leaders and the top competitors?
Yeah. And the thing that I think people don't understand is that every single day something goes up. Something blasts off, some surprise comes out, some oversold stock rallies. There's always something that you can find that goes up. So, but that it has to be done in real time. And the thing that you really have to understand is you're not looking for all the areas that go up. You're looking to trade under a set of parameters that you are an expert in, and that you have reference points that what to expect and what is normal, what's abnormal. It's all about reference points and having a set of parameters that you can operate in, and you have competence in. It's all a matter of operating in your circle of competence. I've always told this story how Warren Buffett, I don't know, most people know this, but Bill Gates is like very, very good friends with Warren Buffett. They're like best of friends. They're very, very close friends. Warren Buffett has never owned a single share of Microsoft. Why is that? And Microsoft's a great company, but it just doesn't come into his wheelhouse. Warren Buffett has his parameters, and he's disciplined, just like I am, and I'm not going to trade a stock unless it comes into my wheelhouse. So that's really the answer, is really to, if laggards are in your wheelhouse and you're an expert at trading laggards, well, then I guess, then you would trade the laggards. But
Yeah, and then, Mark, I would add that if you have a very, very short time frame, and you're trading just for a couple of days, then you could buy almost anything that sets up a little base and breaks out.
That's right.
So, but if you want to get, and this is where I feel more comfortable. If you want to get longer term moves, moves that are going to last months or even over a year, then you're going to need something that has earnings and consistent earnings and accelerating earnings. And those are the ones that I'm looking for. And those are the ones that I want to be in. And so you're not going to have something that has a low relative strength and no earnings. It's going to have all the characteristics we look for. But again, if you're a short-term trader, it's not going to matter what you're looking at. You're just going to be looking at a chart, and you're just going to be looking for breakouts or so.
Yeah, I think that's a great point. Like I said before, if you're trading really small moves, you're a short-term trader, you could trade just about anything, and you're not as worried about the fundamentals. But again, that's a good point. So let's see. Why does a breakout year attract institutions? Breakout year, of course, referring to earnings, because like I said before, they're looking for, they'll use regression and things like that, and looking for changes, significant changes that are showing that something's happening, that is a positive change, maybe with the company that hasn't been picked up yet. So they'll run these, of course, in this day and age with computer models and you can screen and have all these very powerful computer programs that are looking at everything every day. And the minute something changes, bang, it comes up and it'll flag it. So it's more important than ever. Let's see. So 84, page 84. Let's see here. So explain the relationship between acceleration versus the growth rate. So very simply, when you're seeing, let's say your current earnings are coming in at, in this case, 44%, 183%, estimated 900% the next quarter, but your growth rate is much less. That's an acceleration versus the growth rate. Just, a big number versus your maybe your 3 or 5 year growth rate. So just looking for a number. And again, this will happen a lot of times in turnaround situations. You'll have a negative or a very low growth rates. The company came on hard times for a while. Maybe they're only growing at 3%, and then all of a sudden they start seeing those big quarters come in. And again, like David and I talked about before, when you're in a turnaround situation, you usually want to see at least 1 or 2 quarters up triple digits to really get an idea that it has really turned around. And that's because you're going against what they call easy comps, and that would be those negative rates or maybe a penny per share, those really easy numbers to beat. So because they're so easy to beat, you want to really annihilate them. There should be a huge beat and have big numbers in the most recent quarters. Let's see here.
Just as a quick comment there too, Mark, it's very possible we could see some turnaround situations, say in the next 3 to 6 months, because there were a lot of companies, say in Q1 or Q2 that got crushed because of COVID, and they're going to be going against easy comps.
Absolutely. We have what they call the stay home stocks now, right? So like Zoom is benefiting. We have a bunch of names, Teladoc and these companies that benefited from people staying at home, made money and had accelerating earnings. And now you've got malls and hotels and airlines and a whole bunch of industries that movie theaters and so forth, that their earnings got decimated. So that's where you'll start to look for those turnaround situations down the road. So I think that's a great point. Let's see. So it's mentioned double bottom on page 101. Do you use double bottoms? See, I don't really like to get into the semantics of of whether it's a double bottom or it's a cup with handle. Although, yes, the answer is yes. I do use double bottoms, and but these are I mapped out basically these are the 5 price patterns that I'm looking to find, and the grand majority of them, almost all of them, are going to be in. I'd say 95% of them are going to be cups, cup with handles, cup cheats, load cheats, which is all basically a cup with a handle forming, and a power play. And then you might get, shorter flat bases, which I call a Darvas box. You can call it a flat base, and then occasionally a double bottom, which just undercuts the low in the or tests the low in the base. But you still want the VCP. You still want tightness on the right side, so you're still looking for all the same things. So I wouldn't get too hung up in the semantics of what they're called.
And Mark, this is where I would add too, is that so many people are looking for this cup and handle, and they're looking for this flat base, and they're looking for all these different patterns. But I always take it down to making it as simple as possible. If you just draw a line, I just call it the draw the line method. Draw a line across the majority of tops, then that will be your buy point. Lots of times, there you go. That's it. There's your buy point, right as it goes through that high on the left below the arrow. But lots of times, all the stuff that's going on below that, you don't even have to look at. You don't even have to figure out what it is. You're looking for that VCP pattern right below the majority of highs, and that's where your buy spot's going to be, combined with fundamentals.
Yeah, I mean, you're going to do some measurement, and you're going to measure how deep the base is and see if it's too deep. But once you figure out, okay, this isn't a correction, you're looking for that, like David and I said, we're looking at right side. We're looking for that tightness. We're looking for that VCP action, and that's really what dominates our decision making for going into the trade. We don't really care, if it's a W, what shape it is. Just if it's not V-shaped and it's able to put in some time and have that well-developed right side, get good at finding those VCPs. Once you get good at finding those VCPs, you'll start to see the cheat and the low cheat, and you'll be able to buy up that right side, and you'll be buying stocks coming out of bases, and life will be a lot easier. Believe me, it just takes time. So this is a question I think we all should talk about. It's a very popular and misunderstood question. How do you manage position sizing when buying leaders before the overall market turns? How much percentage risk of total portfolio should be taken? I'm sure we'll probably all give slightly different answers, but we're going to talk about risk later on, and we talk about position sizing. But Mark, let me start off with you, because I mean, you're up close to a couple 100% this year, and we came off of a tremendously difficult check your gut Pepto-Bismol decline of epic proportion. What, as far as like when you're getting back in the market and it's so difficult, and you might be buying even before the market makes its low, you buy some stocks and the market's in a downtrend. As far as position sizing, how are you starting off and then ramping yourself up?
Yeah, the same, generally the same way every time. Normally, I'm not looking to just plunge in. I generally think, okay, I'm willing to risk, say, 1 to 1.5%, talking about total equity, on a first position or two. And the minute things start working, I may bump that up a little bit, but I'm using whatever positive feedback I'm getting to give me the confidence to maybe add a little more exposure or take on a little more risk.
Right. And when Mark says 1% of total equity, we're going to get into this later. In risk management, there's 3 sections of risk management, huge section. But we're going to get into all this in position sizing. And what he's talking about is 1% of total equity means if you had a 25% position size and you took a 10% stop on that, that would be 2.5%, right, of 25%. So that would be 2.5% of total equity. So he's talking about 1% of total equity. So if he took a 10% position, he took a 10% stop, that would be 1%. If you took a 20% position, a 5% stop would give you that 1% of total equity. So, easing in there, using, this is what I call progressive exposure. And again, we're going to talk about this a lot later on, where you start with smaller positions, and then you let those positions finance your risk. Dave, as far as you getting into the market, I know you're a little more diversified than someone like myself or Mark. You tend to have a 10 stock or maybe more portfolio. We may have that many positions, but we sort of concentrate in a handful of them. How are you getting in as far as in position sizing early on?
Well, it's the same thing as what Mark said. You go in progressively, and you start small. And if it's if it's a very, very difficult market, you're going through a bear market, then you start smaller in your position. So instead of quickly buying a 5% position, you might start at a 2.5% position, and then if it starts working out, then you start adding to it. But you just don't start off big, and you don't take huge positions right off the start, because usually when you're at a bottom, there's going to be a lot of volatility, and you can easily get shaken out of what could be the next big leader if you get in and start getting too big in this stock, and then you've got the market's thrashing around. But if you have a smaller position, then it's a lot easier to stay with it until the overall market starts calming down, and the stock starts getting into a nice uptrend.
Yeah, that's a great point. When you're making a bottom in the market, there's usually a lot of whipsawing back and forth in the market, big up days and down days. As a matter of fact, the biggest up days occur in bear markets, believe it or not. And in bull markets, you have a lot less big up days, and there's a lot less volatility. It's more of a very consistent uptrend, and you don't have that volatility. That's how you characterize the difference between bull and bear markets. So you want that trend to be in place. You're not. People are so hung up on picking bottoms. It's so ridiculous, because you don't make all your money on that one day if you pick the absolute low, you don't make all your money picking a low. There's a whole year and 5 years and 10 years of investing that you have to do from that point forward. It's not made because you picked the low. And even if you did, you'd have to be in the right stocks at the right time. It's a fruitless endeavor to worry about picking bottoms. So anyway, I ease in, stock starts setting up. I take a few. Usually I'll go up to 25% invested my first leg in. And if things are working, I move to 50%. That could be 2 stocks at 25%, or it could be 5 stocks or 10 stocks at 5% each. It depends. If there's a whole bunch of names and maybe I'm a little bit more concerned about the market, I might take smaller positions and buy more names. If there's not as many, but I see some really sharp setups, I might go in there and just take 1 or 2 and 10 or 15 or 20% positions in each one. But again, that's something that you're going to have to make that determination at the particular time. Page 108 again. I guess so. We're charting this stock against the NASDAQ. The question is, why chart it against the NASDAQ versus the S&P, or is there something that we should excuse me, use one or the other? A lot of times I'll just put NASDAQ stocks against the NASDAQ, and stocks that maybe are more institutional, although Apple is sort of an institutional name, less so back here in 2004. But again, Dave, as far as charting stocks against the market, I'm always using the S&P and the NASDAQ. So is there any advantage of using one over the other?
No. I guess if you have a NASDAQ stock and you want to compare it to what the NASDAQ is doing, I guess you can do that. But that's why I always put a lot of emphasis on that relative strength line, because that's against the S&P 500. And so you can see what your stock is doing against the general market. And that's a good tool to look at.
Yes. And if you're looking at the NASDAQ, if you were to compare it to the NASDAQ and had an RS line against the S&P, you'd kind of be looking at both too. Or you could, you can stack it over both indexes. Sometimes, we've gotten into a much more bifurcated market, I think, in recent times, where they decouple maybe more than they used to. But again, they pretty much, the market overall, the longer term trend in the market, usually the NASDAQ and the S&P are pretty much, close to each other. Let's see. So page 123. Why isn't the 2-day move up down between T2, T3 a volatility contraction? This 2 days too short. So the 2-day move between T3 and the T2 and 3. Okay, so right here. Why isn't that? Well, because I'll tell you why. Because this decline right here was larger, was probably just about the same, as this decline. So it really wasn't a new number, if you will. But it could have easily been. The answer is no. 2 days is not too short. It could be 1 day. So it could be maybe if this is a little bit tighter, you would have said it's a 4T. It doesn't really matter though. I mean, it really, you get, it's tightening up. You can see here, however you want to draw them. If you draw them and you happen to, maybe one is a little bit tighter than the other, but I think these were pretty much the exact same. So it really wasn't a tighter pullback. And this is a little bit looser, maybe, it would be pretty much the same. Let's see here. So page 123, same page. You say for low risk entry, the last contraction should be single digits. Have you a rule of thumb how long that contraction should be? So so a minimum number of days, it could be 1 day. It could be a pause pivot. It really, you have to assess the symmetry. And for a 1 day pause pivot, yes, it would have to make sense in the overall structure. And again, that's why you have to use your eye. And I don't remember if you said this before, Dave, but I know you might have, but you say it usually every year. And I love this analogy of, it's like grading a diamond. We talked about this before. When you grade a diamond is graded not by a computer. It's graded by a gemologist, and they look at it, and they have to go in there and look at the inclusions and figure out those inclusions. I mean, you can have a computer look and count how many pieces of carbon are in there, but they can't say whether it's a feather or they have all these names for them, a cloud, a feather. A gemologist has to go in there with his eye and grade the diamond, even though if you look at them from far away, you can't even see it. Or it all pretty much looks the same. It still needs to be graded. They haven't figured out a way to have a computer grade a diamond, not as effectively as a gemologist. This is the exact same thing. You're looking at that structure and you can see it's tightening, and then you go in there and you start forensically looking at the days and the volume. And this is something that, this is the art side of it. And I've taken this, I think, and made it as scientific or as quantifiable as possible. I don't think I can quantify it a whole lot more, but there's it's like a fingerprint, and you go in there and you got to look at it. Every fingerprint's different, but from far away they all look the same.
Yeah, and I would just add to that too. Just for everybody's benefit, I make this point all the time, but everybody's listening to two guys who've literally looked at millions and millions of stock charts. So in the stock charting world, you're listening to two master gemologists. And the only way to get there is to put in the time.
Yes, and do exactly what David said. Look at the best charts. You start with my books, O'Neill's books, our workbook, and you've got all these models. And this is where these are your precedents. Get good at spotting stocks that look like these, and then you'll start to see the nuances, and you'll build on that. But it's a very progressive thing. You've got to start off with seeing the basic structure and then honing it down. It's no different than anything. I mean, when you start any type of endeavor, when you start, maybe first learning how to throw a basketball, you're just simply just tossing it up there at the rim. After a while, you're worried about your wrist movement and, like where your elbow is, and it gets more intricate. Same like with a golf swing, you won't know all the intricacies that a really seasoned coach would know and be able to see and put you on an analyzer and say, see this, where your elbow is, and where you are at the top of the position, where your club's laid off, all these little tiny nuances, you're not going to be good at seeing until you've done it over and over. You fully understand it, but you'll start to build, and you'll start to see all that over and over, especially when you start taking pictures of your trades, and then you go do post analysis and you compare them, and you say, okay, well, let me see what I did here, and then compare it to what you saw myself do, especially if something. That's why we have Minervini Private Access, where you can actually see, us placing the trades, how we're handling them, and really get, to fly in the cockpit and see how it's done. And, same thing with these charts. You want to compare as where you're buying and where I was buying them, and try to emulate that. All right, let me move on because we got a lot to go here. So how do you know how many T's is it going to have? So is it easy? Let's see. It's easy for me to set the buy point at the third T or even the second T. How do I know which T to set it at? Okay, so Dave, I'll let you answer that too. It's all about the tightness on the right side, as far as, it has to be in single digits usually for me to to say that that's the final T. Maybe 10%, but if it's 15%, I'm not interested. It's too wide for me. But how do you determine, Dave, seeing as your main first eyeball that you're looking at, thing you're eyeing is the right side and that tightness? How do you determine whether that's the T that you want to buy, or it needs to tighten up even more?
Well, it's just, again, it's the look of the chart. If the stock has been getting tighter and tighter, then it gets to a point where any tighter and it's going to flatline. Yeah, if the stock is all over the place, at 20% up and back, it's just, you want that period of calmness, of where there's very little activity. And it's as you said, I think you just mentioned, you don't want any of that to be any bigger than 10%. You want it small. To me, it's the tighter the better. But it going T1, 2, 3, it's usually 3. If it goes on too long, then the stock maybe might never break out. So right. I think just 2 or 3 of them, maybe 4 of them, but after that, yeah.
Well, we actually have some hard data on that. Anywhere between 2 and 4 is the norm. That's what you generally will see them. You could get a coupled handle and it has a correction, then it builds a handle, and it only contracts that one time, which would be a 2T. The most of them are 3 to 4, and if it gets more, we found that if it gets more than 5 or 6, particularly 6, if you go to 7, more than 6 is abnormal. Very seldom do you see 6 tightenings, especially if it starts to look lopsided, where the right side is long and it's longer than it would look symmetrical. So there is some symmetry that you'll start to see. It's really amazing on how it works, but it just it's that towel wringing out that water. And when the water finally comes out and that right side tightens up and you get that symmetry, the supply stopped coming to market, and that's basically it. But again, it is the look there. As far as Mark, you're really you're like me, you're really tight on the risk and want to make sure that it's as tight as possible on that right side. I want it, if it could just have no movement at all and just be unchanged for 2 days, I would love it. Again, any insights on how to spot when the stock is ready, buyable, ready to go?
Yeah, I think David nailed it. The tighter, the better, obviously. And then you guys didn't talk about, that volume too. Maybe you only get the 2 T's, but if that volume's really dry and that second tightening, it might be ready.
That's right. That's not, price isn't your only measure. The volume, that's why you're looking at the volume. You want to see that volume contract. And when you get to where, let's just say that last day is in a 1 or 2% range and the volume is 80% below average daily volume, that's about as close as it's going to get. It needs to move right then and there. Now you're looking for it to move within a number of days. And that's how they move on Q. There's so many times, I'll put a stock out as a buy and, bang, it takes off. And, people think, sometimes we're manipulating it. No, not at all. It's the only thing is it's manipulatable. At that particular point, yes, the stock is manipulatable, not by us, but just simply because there's no supply. So even a small amount of buying is going to move it. So it's not that you're manipulating it. It's just that you're getting good at finding when the stock is manipulatable, if that makes sense. Let's see here. General guidelines on entries close to earnings dates. The breakout, say, occurs 2 or 3 days before earnings announcements. Would you still buy? So, Mark, I'm definitely going to default to you because you just came up with a name just recently that we put on, and we put it on. I think it was either the same day or the day before earnings, right?
Sure. Yeah.
What's your rationale behind that? Buying a stock the day before earnings.
Well, the stock's breaking out. So I generally assume that the market is smarter than me. So if the stock is breaking out ahead of, if it's 5 minutes before the close, I'm not going to buy the name most likely.
Right.
But if it's in the morning and the stock has earnings that afternoon, I may get a cushion and be able to hold through the announcement. So no, generally, I just follow the breakouts.
Yeah. Yeah. And I'll buy sometimes, right before earnings and see if the stock will run up. I mean, there's times where the stock runs up 10% the day or 2 days before earnings. If I'm at a 10% profit, great. I can go into earnings now and I can take that risk and try to get paid on a nice big gap. So, but then again, Mark, let's say you buy that stock, earnings are coming out tonight. You buy it in the morning. You're going to say, okay, I'm going to see if I can get at a cushion here today. But then maybe it comes off. You're off 1 or 2% by the end of the day. Might you kick it out then?
Always, well, almost always. So I have a general rule that usually if I don't have a cushion, I almost never hold through earnings unless it's a really small position.
Right.
But no, as a general rule, without a cushion, I don't hold at all.
Right. Yeah, me too. And if I'm going to position size accordingly, and I'm definitely look. The rule here's the general rule. I'll give you a general rule. You never ever take big risk before a key report. So you're not going to ever put yourself in a position where you're taking a lot of risk going into an earnings report. Absolutely not. All right, let's take a look here. So page 120, 127. After the contraction number 2, mid-March, is it considered a low cheat? So we already answered this, I think. Maybe someone else asked it in a different way, but right here, yes, it is a low cheat. So we'll mark that one more time, but that is a low cheat right there. Absolutely. All right, let me see here. 128. Okay, so this is the explanation of supply and demand with the trapped buyers and the bottom fishers. And let me get that little line out of there. News-driven volatility like vaccine news, Pfizer and Moderna affected the previous leaders. Are bases still expected or the damage done by the market on these fluctuations discounted in the analysis? So how do you handle them? So, all right. So I'm gonna make this very simple, and I know my other 2 colleagues will do the same thing. Look, you forget about all that. If the chart's set up, it's set up. Whether if your question is, well, are we going to change the rules or maybe trade something more volatile or or try to say, okay, well, it's different this time and there's a lot of news so we can buy volatile stocks? No. And I've never seen. I've been in the market since 1983. Okay, so we're talking 37 years or so. In that time, 8 bull markets, 8 bear markets. I've never seen a single market, no matter how volatile it is. And I've seen some markets in 2008, 2009 was unbelievable. The bear market in 2000, the crash of 87, of course, 2020, some volatile, crazy situations. And I've never, ever seen a single market where I didn't have tight price setups and I didn't have, that I had to break my rules. Never, not one single time. Dave, you've been doing it longer than me. Has there ever been a period where you couldn't participate in a bull market because the stocks were all too volatile and nothing set up?
No. There's always names out there, and I was talking to somebody today about the news, and what do you do about the news? It's the news will be reflected in these charts, and so it's almost you're going to get yourself all twisted up and mixed up if you try to equate the news with what the market's doing, because lots of times it does not make sense. What is happening. So yeah, that's why you just have to listen to the market and not listen to the headlines that are constantly blaring at you and tweets that are coming at you from all sides.
I feel like why use charts if you're going to be looking at news and override and then why use charts in the first place?
Yeah, because the market is looking out. It's looking out ahead. What you're seeing in the news today or the headlines is what the market already dealt with months ago. I mean, just look at the turn. Look at this year, and look how we came off the bottom. Well, we came off the bottom because some of these companies were going to be filling a need and coming up with some good earnings, and that's why the market came back up. So you just gotta watch, look at the information and not look at what the news is telling.
Unless
I would encourage you to shut the news off if you're new at this. Just shut it off entirely. Just follow the stocks.
Yeah, unless it's a true surprise. I mean, it comes out of nowhere. You may, but those are impossible to know. You're not going to know them. I mean, even sometimes the CEO of the company doesn't know when all of a sudden they have a contract that's awarded and they get a yes, they get the nod from a company that they've been courting. I mean, so again. I always wanted to use charts to cut through the noise and to be able to get around the news and to be able to actually be ahead of the news. There was a saying in my office for many years when I was in New York, when new people used to come work for me, a lot of times, my workers would say, Minervini's got Monday's newspaper on Friday. And meaning that, I'd buy these stocks and then whammo, they're just blasting off. And then all of a sudden, the earnings would come out or some news would come out and the stock had already run up. But I was just trading the charts, just trading the breakouts. I didn't have any real special talent, clairvoyance or crystal ball, other than letting the the setups guide me and buying from those very tight low risk entry points where supply stopped coming to market. So I put myself in a position to get lucky. See, that's what it's all about. This is a bad analogy, but I always say, if you want to get hit by a car, no one would want to get hit by a car, but let's just say your goal was to get hit by a car. What would you do? You go and you run on a busy highway, right? You go and run back and forth where there's all cars whizzing by and they're so fast that they can't stop for you and you jump in front of them. Okay, well, that's what I do. I jump in front of enough stocks that meet the criteria, and I get struck every now and then, and I manage my risk in relation to that. So it's just a matter of putting yourself in a position to get quote unquote lucky, if you will. All right, so I'll let you answer this, Mark, first. So you said about backing into risk, the pivot point VCP. Can you explain backing into risk? And I know, Mark, you're, if there's one thing you're great at, and that is backing into risk. So what does that even mean?
One, it means you have, predefined risk. You know where you're going to get out and how much you're going to lose if and when you're wrong. That's how I think about it first.
Backing into the chart. This is referring to backing into the chart, using the chart to back into risk based on the chart.
So you're saying that's what the question is asking? Sorry.
Yeah, the question is saying, I said that you back into risk. I back into the risk, and I back into the VCP. So I'm backing into risk based on the chart. I'm letting the chart tell me, where there's the low risk trades.
Right. So, yeah, meaning he knows right where the chart sours. Where the chart sours is where he's wrong. So that basically tells you what your potential risk is on any one given trade. And so let's say, for example, you want to risk 1% of your total equity on a given trade. If you know where that chart sours, then you back into your position based on that point.
Right. So if you have a chart that is got a pivot point or a base that's in let's say a 5% range, and the bottom of that range would stop you up. Well, that's a 5% risk. So you would be matching your risk tolerance with the chart. You'd be picking the stock based on that, as opposed to, let's just say a stock has its right side is fluctuating back and forth in a 20% range. And for it to look abnormal, it would have to take out the low 20% lower. Well, that's not, you're not going to be managing risk too well there. You've got to wait until the stock drops 20% before something abnormal is happening. So that's another big benefit of having very tight price action. Dave, same question as far as that right side, and how does that help you with risk?
Well, when it tightens up, it gives you it's a very small trading range. As you're going through that VCP, it actually gives you a much easier out point, or you can define your risk better when something is very, very tight before the breakout than if you're just using an 8% stop. So that's, if the chart is right, it helps reduce your risk.
Right. So you have that mathematical stop maybe, but you also have the actual price action of the trade. We're going to get into this later on. We have, like I said, the risk management section is the biggest section of the whole program. So we're going to talk a lot about risk. Let's see. All right. Let me just scroll down here. Okay. How do we know if the stock price is extended? Given growth stocks keep going up and up and up, how do we know it's extended? So, Dave, what's the definition of extended? How do we know the stock's extended? And we
well, it depends on how far you're going to buy from that pivot point, and so you can. When I first started, it was 10%, and now but you always want to be buying right as the stock is coming out of that buy point. Yeah, just on that the example you just put up, you want to be buying if that pivot point is $5.10, you want to be buying at $5.11, and I wouldn't go any farther than 5% from that spot. So that's why you have to either have buy stops set if you're not going to be watching, or you got to be very quick as that starts moving, so you can buy as close to that buy point as possible. But once the stock is extended, you've got to let it go. You got to wait until the stock either pulls back close to that buy point or sets up another base. And sooner or later it will. When a stock makes a big move over a year or a year and a quarter, you're gonna have multiple times to get into that stock.
Right, and we're going to show you also when selling into strength as to where you will see and identify when a stock is extended and you want to be selling, and as opposed to when it's just breaking out. But later on, when you're looking to nail down a profit into strength, we'll talk about that. That's also we'll share a definition of extended. Question on page 141, which is the one we're on. Can David elaborate on the rationale and what we were looking for in past volume spikes? So I'm not sure why this particular chart, but that's the question. And maybe you can just talk about in general what you would look for, looking for past volume spikes. I guess that means, prior to the buy point.
Yeah. And you have to keep in mind that volume is supply and demand. That's the, basics of economics. And so what you want to see when a stock is basing is you want to see that volume lighten up. You want to see it dropping off. You want to see the supply, fewer sellers coming into that stock as it's going sideways. And as you look at the prior uptrend, you want to see volume picking up, especially out of when the stock is coming out of buy points and coming out of bases. Volume is most important once, as the stock is coming out of a base. Once the stock is up and running, then the volume does not have to be big every single day. And then when you go into the base, as a base starts forming, yes, the first few days down into a base is probably going to be heavier, but then as the base goes on, you want it to lighten up. And then there's some good examples of some big volume spikes to the upside as the stock is moving higher. And that's you just and sometimes all you have to do is, now this is a one color chart, but so many, you can set your chart settings any way you want, and you can just look at the colors at the bottom of the chart, and lots of times you can see patterns just within the volume, how the volume is setting up. And the other thing is you just look for, you look for blue for up days, and you're going to see, if you see a lot of those, you're going to see a stock that's probably under accumulation or is in a very, very nice uptrend.
Yeah, in this case, and I always love to see a big move on earnings prior and then a base form after, and I get that post-earnings drift. But again, I'm looking for supportive action and I'm looking for contrast. So you see big volume spike, comes back in, volume quiets way down. Look, see that tight area right there? That's almost buyable. That's so tight. Look at the volume. And then wham. The volume comes back in. This is getting forensic and really starting to analyze within the base. You're not necessarily buying here, but you might not even see the stock here. You might be looking at it over here, and you just saw it and it tightened up. Now you go back and you start looking, okay, let's see the quality of this base. This is where you're the gemologist and you're starting to look at the diamond and to see the cut, the clarity, the color, and really started to see what is the quality of this base. Okay, so then even here, I marked this right here because this came back but had a good close, and that's supportive action. And you're just seeing tons of support. Every time this stock comes back down, it's coming back up with volume, and it's drying up as it comes in until finally the volume's relatively low here, and then you get nice and tight, and then you come right out of there, and that's it. You go inside. There's that inside day that we talked about right before it goes, and you see it comes right to what I call a specific entry point. That's your specific entry point. Right on that day, that's when you should be buying that stock, and you can see how it comes right out 1, 2, 3 out of 4 days up, and big move in 10 months. So that's, again, it's going to take time for you to get those X-ray eyes. If I take all this out of here and maybe have a little bit more difficult example, I don't know, whatever, there's all different examples here, but we take all the drawings out and, you might not be as clear, but after a while it will be. If you keep looking at these, it'll become clearer and clearer.
And I was going to say that what an advantage to now have color. I mean, for the first 20 years of my career, I don't think there was any color charts. Everything was black and white. And so you had to really look closely to see was that an up day or a down day? Was that a blue spike or a red spike?
Yes, it was much more difficult. And remember, we used to use you remember Mansfield charts, Dave?
Yeah. Oh, yeah.
Yeah, those were those little tiny thumbnails, and they were printed really badly too. They weren't printed very good. It was all ink blots on them, and but that's what we had to work with. And I made a lot of money with those charts. Let's see. So how far back, Dave, how far back are you looking for overhead supply? 1 year, 2 years? What's the general rule at looking at overhead supply?
I look back. I mean, I usually look back about a year, but like this example, I guess you're looking at. Looks like it starts in April, so that's probably about 9 months. But you can see that's even if you look on this chart, April and May, that's not much overhead supply, and no. It's 9 months ago, and almost everything is built under that 17.25 price. So that I wouldn't even consider that as really any overhead supply.
So the general rule, the rule of thumb with overhead supply is also the depth of where your right side resides based on in relation to the depth. So if you had I don't have a drawing board here, but if you have a decline, let's just say it's 70%, right? And then you come up this right side and you form your, I see this all the time when people say, hey, is this a buy point? I see a cheat area. And this decline, the cup portion, is an 80% decline. All right, well and this is only, let's just say this area right here, I'll get the spotlight again, right here, all this is 3 months ago, so this is like a 6-month decline. Well, that's very close and very deep. So now you have a lot of trap buyers. Just think about it as, try to always relate it to people buying and selling. Look at the chart and think about buying and selling decisions. If you were an institution, where would you be buying probably? Or where, if you were an individual, where might you get shaken out of the stock and get scared? So if you have people buying this stock up here and it comes down 80%, you've got all the way down, you've got losses. You've got people at every level have big losses. So every time this stock tries to rally, it's running into someone who's getting a group of investors that are just getting even. And that's why a really deep correction you want to stay away from, or it needs more time. So it has to be in relation to the time factor. Time and price have to be taken.
Yeah, and Mark, I always had a rule that if a stock declined more than 50% within the last year, then I was probably not going to be looking at it for a long time, because it needs a long time to recover from that correction. Because if a stock comes off 50%, it's got to double to get back to its old high, and that expends a lot of energy. So you have to be careful that, especially if you're in a good market, or even if you go through a correction of 10, 15%, if your stock comes off 50%, or a stock that you're looking at has come off 50%, you have to be very, very careful. The only time I ever saw that not work was when we were in the crazy period of 99 through March of 2000, when I would see internet companies that would correct over 50%. They would come back to old highs, break out and double from there. But that's a period of time that only comes around like once every 20 or 30 years.
Yeah, two things that I would comment on that. One is that the 1 year, using to say that it 50% in 1 year, any stock that goes down 60%, when it starts getting to the 60% or more level, it's pretty much completely off my list. 50%, if the base is large enough and the right side really tightens up, where a lot of times you'll get a whole new base, part of that big base, there'll be a base within that base, and that's fine. But the 1 year rule is really good, and I'll tell you why, because it allows you to give the time for 1 year to have a big 52 or maybe 65 week base. And then that 50% decline might be viable if it has a very large base. So again, it has to be taken into consideration. Okay, so, and Dave, this is definitely for you, because base on base and ascending base are both O'Neill terms. He termed base on base and ascending bases. A question, what's a base on base, and what is the difference? What's an ascending base?
Yeah, no, I actually, well, a base on base is just a stock that has built a base, it breaks out, and then it really doesn't make much progress. But it maybe goes, 10%, and then it starts forming a whole new base. And then it's just, it just sits on top of the previous base. That's what a base on base is. It's like, it's a base that really, didn't go anywhere and built another sideways action. Ascending base, that's actually something new, and something, since I left O'Neill, and I would more, maybe Arusha would be a better someone to ask exactly the right definition.
Yeah, ascending base is a very, very rare occurrence. Does anybody know where the lumber liquidator? I know where it is. I'm asking you guys to tell me where stock is on my workbook. That's comical, isn't it? Hold on a second. I know where it is. It's about right over here somewhere. At least I think I know where it is. Let's see. Lumber liquidators. Actually, no, it's down in where we compare picture worth $1 million, right? Let's see. Let me find it here. It's right in here somewhere. Maybe I'm wrong. Lumber liquidators. I'm looking for lumber liquidators. Anybody knows the page? Let me know.
Slide 12, Mark.
Where is it? Where is it? No, page 12. Yeah. Okay. All right. And anyway, I just drew this just to show you base on bases. If you have a sideways base, breaks out, and then it builds a base and sits right on top of it. A lot of times that will happen base, and this isn't related to the chart, just a little drawing because I don't have a whiteboard. A lot of times that'll happen. The stock will break out, and then you'll have a correction in the market, and it'll hold it back, and that's what will make it build a new base. So this is really probably the best example I have of an ascending base right here. And a lot of times the ascending base won't have a lot of days or weeks. It might only be maybe, there's 4 or 5 weeks, it breaks out, then another 4 or 5, and then it breaks out again, and there's like 3 weeks, but it's within a downtrend. You see how the market's in a downtrend, and this is stair-stepping its way higher. That's an ascending base, essentially, where you get, and sometimes it'll be a lot tighter than this. You won't have such a big move, but you'll have this ascending, these short sideways moves that will diverge from the market. It's a much trickier, but I could tell you right now, an ascending base happens probably, I'd say, less than 1% of the time, versus a cup with handle, a cheat area, a low cheat. That's like 99.9% of the time, you're going to get either a low cheat, a cup with handle, or a power play. That's pretty much like encompasses virtually everything. All right.
And Mark, I actually have a definition from some material I have from MarketSmith. An ascending base. The shape is 3 pullbacks, each making a higher high and a higher low, showing an overall uptrend. The base length is usually 9 to 16 weeks.
Right.
And the correction in the base is usually each pullback is 10 to 20% from the previous peak. And the pivot point is the breakout above the left side of the high of the third pullback. So I think your example that you showed before was a very good example.
It's pretty much perfect.
That.
Yeah, that's pretty much exactly what's happening here.
Yeah. And the base characteristics, it's usually not a first stage base. It's usually farther along in its move. And it often formed when a strong stock resists the general market weakness, just exactly like you said. So that's a great, Lumber Liquidators is a great example of that.
Yeah, it's a textbook, in my opinion, ascending base for my definition of it. But I think now that we got the official definition, it's textbook. So, but again, you're going to see that, and also if that third base is, let's say it's in this particular instance 1, 2, 3, 4, 5, 6. It's like 7 weeks. So you really be keying in on that only. And then if you're comparing it to the market, like I showed you before, you'll see that how it's bucking the market and the relative strength line. Dave, what's the relative strength line doing to this stock? You don't even have to see it to know, right?
Yeah, it's going into new highs. And as you said, you don't really, this is another thing. This is where I think people are getting so caught up in, all these looking for all these different formations. Well, all you do is just draw a line across the top of that third base. I mean, you could do it on all three of those bases and you would still be buying a breakout, and you would never have a violation of your stop point.
No. And that's why it was so powerful. That's why you got the leverage on this, because it just, and this was the reason I keyed in on this and saw this stock when it was setting up was because it reminded me so much of the U.S. Surgicals and the Amgens of 1990. See, again, I'm using precedents. I'm constantly looking and trying to find stocks that look like previous scenarios that I saw during previous bull and bear markets. And you're going to see they set up time and time again. You would think, they with having these things occur over and over and being able to go all the way back to the 1800s and see the exact same thing, why wouldn't everybody be rich from trading stocks? And why wouldn't everybody be doing this? And that's the question I often get. Well, why isn't everybody doing this? Well, let me ask you a question. Why isn't everybody in great shape and thin? I mean, everybody knows you eat less, fat and carbs, and you exercise. Why isn't everybody a lot of things? Because it requires discipline. It requires work. It's not a free lunch here. There's still a lot of work that's involved. And again, there's, this is something that you got to get expertise in. It's not, just doesn't happen automatically for you. Let's see here. All right. So one. All right. 145. Wouldn't the orange circle right here, wouldn't that be a decent pivot? Yeah. I never said it wasn't. I mean, these are all buyable bases. And then you get to that late stage, and now this is becoming more suspect, because now you've got the big 50% or so. I don't know if it's 50, but it's close to it. You got the big decline. You got the deeper right side, your late stage. So as you're getting later and later, as I pointed out before, the early bases are what I call investment grade. As you get to the third and definitely the fourth and fifth, you're now getting into tradable situations where now you can trade coming out of those bases, but you want to trade right out into strength, and you're not pyramiding anymore. You're not adding on subsequent bases. Now you're using strength itself. I got to move a little bit quicker here because I know we're getting long on time here. We're going to go for about another half hour, maybe 40 minutes tops. So I want to try to move through these questions. Let's see. Okay, so 147. And again, I'm not sure why this is relating to this slide, but do you ever wait till later in the morning for purchase if the stock pulls in a bit on the minute by minute chart? All right, so Mark, you're out of all of us, you might be the most shorter term trader, I would think. But as far as do you ever use like 1 minute charts or anything like that for your buys?
No, I have an intraday chart normally that I'll have up. But no, I don't do a lot of intraday trading. And then I think the question was, do you buy was it right off the open or something like that?
Yeah, wait later. Do you ever wait till later in the morning for purchase if the stock pulls in a bit on the minute by minute chart? So I guess
Okay, yeah.
looking at the 1 minute, maybe seeing it pull back to the breakout. And again, I'm not really using the 1 minute for that. I'm still using the daily myself, even though I might, maybe I do buy it if it pulls back a bit. Sometimes the stock will break out and I don't buy it, and then it pulls in a bit and it comes back to the breakout. Yeah, I might buy it. Yeah, if it's just pulling back pretty normally, and I might buy it. There's a lot of times where I buy a early morning squat.
Sure, I'll do that as well. And I don't usually, I may give the stock a few minutes if it's opening right near a pivot point. But if it's tight and it just starts going off the open, I generally start buying. I might not buy all my position, but I'll start buying.
Yeah, and Dave, you kind of avoid at least the first 15 minutes or 30 minutes of the day.
I usually like to, but as Mark said, I mean, if the stock looks absolutely perfect, I want to get something going, but I'm not going to buy my full position right off the opening. I'll buy a partial of it, and then see how it reacts. Or sometimes a stock gaps a few points, and it's actually already more than 5% past the buy point. Lots of times you get a second chance. They pull in intraday, and that's where I might start the position.
Yeah, I think I just did that with TGT. I bought TGT and on the earnings, and it gapped a little bit, but it didn't gap more than 1% or so above the pivot, and then it pulled in a little bit, and I bought it. So I actually just did that just recently.
Yeah.
Let's see. So here's a question on a gap, page 147, which is the next right here. So after proper pivot formation, we wait for the price to cross the high, but many times the stock gaps up 4 or 5%. In that case, what do we do? Okay, so we stay away from it, And again, I'm going to go back to Mark and Dave. I mean, are you guys ever falling in love with the stock so much that you're going to go and chase it up 5 or 10% on a gap?
No.
And I'm a no. So you got 3 no's there. So you got a pretty hard rule there. I'm never doing that. Never ever am I chasing the stock up on a gap. That's extended from the base. Let's see, page 148. So at March, go back around 4 days, there was a big drop on huge volume on that day, just after a few days of the pivot point. What should we look for to decide holding the stock or not? Is huge volume on a big decline, especially close price at lower part, a big sell signal? So at March, go back around 4 days. March, so we're here. So you must be talking about this pullback right here. I think we had a question on this before, right here. It's a big drop on huge volume on that day. Yeah, that's the only drop I see. So it's going back before March. So it must be right here. So the stock breaks out here. It runs up. Mark, you've been really good at, especially with power plays, sitting through some of these pullbacks that sometimes are violent, but you've tended to do really well being able to hold in there and give the stock a chance to make a bigger move. I mean, first of all, this particular scenario here breaks out, runs up a few days, comes in, has this big down day on a pretty good surge in volume. I mean, is that going to knock you out of the stock?
Hopefully not if I bought it properly.
Yeah, I'm assuming you bought it right here as it's breaking out.
Right. So, yeah, of course, normally I'm just looking at this. This looks like, the way I would handle a situation like this usually is if this stock looks like it ran a little more than 10%. So I may not move my stop up, but I may move it up a little bit because I'm already probably past maybe a little bit of an average gain. But even still, if you moved your stop to even, you bought it perfect, that shouldn't knock you out. Right. And it's normal, to that type of pullback there is, yeah, it's not, it's not ideal, of course, right. But then you get the tennis ball action. Maybe the market had a bad day that day, or whatever. But, you see in 2 days, it was right back. So.
Yeah. The other thing that you could do is look, if you got your position and you're going, you've already filled out your position, and then and then you get scared. You don't have to blow the whole thing out on one day. What you could do if you're really scared, if you're nervous or whatever, just you can cut the position down. Just, maybe sell a little bit and then give it another day. But usually, stocks don't, completely reverse and blow up on one day. They, it takes more to top a stock than just one day of action.
Yeah, and in order to go through and to find out if you have a natural reaction and the stock's going to give you the tennis ball action, you have to go through a pullback. You have to let the stock pull back. That's the whole idea. So you've got to make that determination. When you're up 10%, the stock runs up and breaks out, and you're now up 10%. Well, that's where you've got to make a determination now and say, you don't know it's going to pull back. You don't know if it's going to go higher, but do I need to protect my 10% here? I could sell half of it, move my stop to break even, guarantee myself a 5% profit if the thing comes back down. I can sell half of it, keep my stop where it is. Let's say maybe the stop is at 5 or 7 or 8%, and if it comes back and stops me out, I've cushioned my I've cushioned myself, and I'm going to lose nothing on the trade. Or like Dave said, comes in and now you're getting worried that you're going to wake up tomorrow and it's going to gap down. Sell half. Sell half. The sell half rule, and I'll talk about this later, that's the default action that I take when I'm indecisive. When I don't know what to do, I sell either all of it or half of it when I don't know what to do. If I don't know what to do, a lot of times I just blow the position out and I just get out. But the default that I usually go to is sell half, because then if the stock goes up, I can say, thank God I sold half. If it goes up, I can say, thank God I held half. If it goes down, I can say, thank God I sold half. In either way that the stock goes, I'm right. I become correct for selling half. No other number does that. If you sell 75%, well, then obviously if it goes up, you're less right than if it goes down. And so at half, you're equally right, no matter which way it goes. So it protects you psychologically. But my answer here would be that this should not be knocking you out, and you should be holding to see if this is going to come back, give you that tennis ball action. Another few days down, that would be abnormal, and you'd probably get stopped out anyway. When you first go into a stock, you have a stop, you've made a decision of how much you're going to risk, stick with it. Let the stock break out, let it pull back, see if you can get some tennis ball action. Once you get at a decent gain, then you start thinking about nailing down your profit. Let's see. Oh, okay, 140. Are we on 140? We're on 148. Yeah, over the price, over the pivot price, how many percent pennies over this price would you buy? So Dave said, 1 penny. If it's 70, 01, I tend to give them usually 5, 10, and sometimes 20 cents. So if it's like an Amazon or something, and one of these stocks that's trading $1,000, I might give it 20 cents, but it's usually anywhere between 5 and 10 cents above. I usually don't give it a penny, because to me, 5 or 10 cents isn't going to be much different than a penny. But again, if it, once it gets above that price, if it's $70, that's the price. Yes, 1 penny technically is a breakout, and maybe you start buying it there. But yeah, as soon as it hits that price, that's where you're buying. Let's see. Would it be okay to set multiple buy stops? So this is on page 150. So the question is setting stops between that pivot and then this high here. Absolutely. That's exactly how I would handle a situation like this. Most likely it would move pretty quickly. Once it comes through this pivot, you start buying. A lot of times they just move and they come right out, and you don't even get a chance. I mean, you just really got to just start buying them immediately. But yes, you maybe if you were to put, say, an order in with your broker, and this price is for whatever it is here, $4.95, you have $6 here. Maybe you have it in at 5 cents above there, and then you put another buy in at 5 or 10 cents above the $6 level, and you buy them as long as it's not more than 1 or 2% above that level. Let's see here. We had a lot of questions on this 150 chart for some reason. Are you buying in the 4T 550, or are you buying them? Okay, so that's the same question. Am I buying here or above here? And again, like I pointed this out before, if you got to calculate, all right, let's just say that this price here, let's times this by 10 and say that this price here is at 4 or I'm sorry, we'll say 550. And this, so it's a $55 stock, and then it's the price is, at 60. So it's $5 away. All right, well, that's a good distance. Maybe let's say if it's 5 or 10% away. Excuse me. You have a an advantage to buying it before it gets through these highs here. I would probably start buying or buy my whole position through the pivot. But let's just say that's only 20 cents away. It's 30 or 40 cents away on a $50 or $100 stock. Well, now there's not that much benefit of buying it. I would just wait and let it get through all the price there. I don't know how would you guys handle that, Dave? You're going to buy it and wait to get through these prices right here.
Yeah, I to me that pivot is perfect at 6, and I don't see any other. I mean, I don't see any other buy points here.
Yeah, Mark.
I would tend to nibble on the first one there, whatever 580 or whatever that little pivot is, and then I tend to be incremental on everything.
Yeah.
But I would I'll probably, by the time it comes through 6, I want my whole line on.
That's right. And you don't have to buy it. You don't have to buy at one price. You don't have to buy it all. We don't have to be an either or decision. You can buy some as it starts moving through that first price, and then finish up your position if it confirms and it moves to the next price, as long as it's not too extended. All right. So
I think the key to the incremental thing people don't understand too is that if this stock is going to work, you're guaranteed to have your line on, where, let's say, hypothetically speaking, it just pokes its head out but can't get through 6. You only have a little bit of the position on. Now you could say, well, there's nothing to be gained. Why wait? Well, that's fine as well. But maybe you're trying to move a lot of shares and just keep a pulse on the market. My point is, if you have pivots that are, say, maybe they're 2% apart or something like that, you could just start your position and then get a feel for them, and then maybe the stock tightens up and you want to it improves, and you can put on even more size. Just again, always being incremental and bending with the market.
Right. Page 171. Dave, we talked about, and Anthony's asking for clarity about why we want to see a big move and have shakeouts be brief. What if you don't get a big move? Why is it necessary to have the shakeout below the low be relatively brief and then move pretty rapidly from that level? Why do we want to see that?
Yeah, well, when you have a shakeout, and this is this doesn't happen that often, but what you want to see is if you get that undercut of that previous low, you want to see that there are buyers under there, and you want to see that they bring that stock back very, very quickly. If it sits down there, if it sits down there below that previous low and sits and goes on for weeks, then there's no buyers. But what that tells me is when the stock trades down and then comes back up, and especially when it closes on the high of the day and then starts a new uptrend, that's telling me there are people in there, there's willing buyers that are just waiting for that, and they're starting to buy the stock up. And what you do is, when you call it a shakeout, you're shaking out the weak holders. You're shaking out all those people who put their stops right there at, looks like 560. You don't have to have a large up day, but you do want that uptrend to get going pretty soon. And then you build a beautiful base, and out you go again.
Yeah, the definition of a shakeout is that you've exhausted the supply, that you've now gotten those last few hands out of there. So it should come right back, especially if you have any type of demand in the stock. You already know the stock's in an uptrend, and institutions will generally, big institutions like Fidelity, they'll start buying their position around the lows. They're the reason why the stock holds up and comes up that right side and will hold those lows, is because they'll suck up those weak hands. They're long-term big buyers, and someone like yourself, you know, this stock comes off and undercuts a low, you probably got your stop in there, you're going to get knocked out. But that's, you know, relative to the big institutions, you'll get, you know, that supply will get gobbled up. So you're looking to find out if the supply has stopped coming to market, and if institutions, if you have some demand there. So that's where you should see it quickly come right back and right up that right side. And that's just giving you an indication that the stock is under accumulation. Again, this is going in and grading, like I said, grading the diamond, grading the base, and trying to figure out the quality of the base. And you wouldn't be buying here anyway. I know it's not, you're not buying undercutting a low here. So you'd be looking at this in hindsight while you maybe spotted this stock while it was tightening up over here. And now you're going to go in and start analyzing the quality of the base.
Yeah, and I think your point on that institutions, they really have to pick and choose the spots where they have to buy. They have to buy when there is stock available. Lots of times when a stock is breaking out, there is not much stock available, or everybody's scrambling to get it all at the same time. But when you get an event like that where a stock is breaking a previous low, there are a lot of people that are giving away their shares, and that's where they can step up and do that. But it's a positive thing when you see that happen. And I can, you know, we're not bringing up current examples, but I would just point out, when you got a chance after this is over, take a look at DocuSign. DocuSign twice hit 189 and then 187, and then just about a week ago it undercut those two spots and immediately started turning back up. Now, I'm not saying that you buy right there, but it's telling you it shook out weak holders, and now it's reforming a base, and it's one that you should be taking a look at, or at least, you know, watching on your watch list.
Right. Let's see, page 174. After a bear market like the 2008-2000 bottom, when most stocks fell more than 60%. Okay, we talked about this before, where no matter how bad the bear market is, you're always going to have stocks that hold up, and you don't have to buy stocks that are down 60%. So we answered this already. Let me see here. 181 stock coming directly off the bottom. Let's see. So the stock coming up directly bottom and forming a tight handle, making the entire setup a little asymmetric, compressed. Is that my understanding? No, this is not compressed, not at all. This is very. I see what you're saying, what you're looking at here, but it's fine. And it would be an example, and I wouldn't have been buying if it wasn't fine. It's got a fine right side. It would be compressed if you're buying it right over here and it didn't put in this time. But no, that's fine. That's now, you know, this is a little trickier because it shook out that low, like we were just talking about. Here, I'll draw a little line here and show you. There's a perfect example of shaking out the lows.
Right.
You know, so right. And you notice, look, it shakes out one day and it's right back up. That's that quick shakeout, and boom, and then it tightens up. See, supply starts coming to market, and then it can move freely. So again, you're going to have these, you know, in different types of formations, but you're really looking for that tightness on the right side, and would simply just be a 2T. All right, let's see. And again, you know, we can impart experience, you know, and we can try to give you many examples, but you're going to have to see lots of these charts and trade them and make tons of mistakes, and you know, this isn't going to happen overnight. So just keep asking the questions and being inquisitive about this stuff. But the main thing is to not get too caught up in all the terminology, and, you know, trade and look for these tight right sides, draw that line across where the majority of the action is, and trade these stocks, and your own results will be an amazing teacher. Let's see.
Yeah, and I would add too, is that especially if you're just starting out and you don't have a whole lot of experience, do not use all your capital. I always say take 90% of it and you know, put it somewhere else where you can't touch it, because you're bound to make a lot of mistakes. But you want to learn from those mistakes with a lot less of the capital that you have. And then as you start gaining confidence and having some success, then you start bringing back that money.
Yeah, the question here, low cheap buy point doesn't does it require volume support? Whether it's a low cheat, a handle, it doesn't matter. They all require the exact same thing. Whether you're coming from the low cheat in the lower third, the cheat in the third, the handle in the upper third, or certainly in the upper half, you're looking for the same exact thing. You're looking for volume to dry up and the volume to expand coming out, but you may not get the volume expansion right away coming out. Sometimes when you're coming off the low cheat, you don't get it right away, or sometimes you get a lot of it coming off the low cheat. You don't get as much coming off the handle. So you're only going to know that in hindsight. You're buying in real time throughout the day. So that's going to have to be determined, and then you'll determine the quality of the breakout. Is there a minimum time frame, 3 to 5 days for a low cheat or handle to last? No, like I said before, it could be as little as 1 day, but usually it's a number of days to weeks. Let's see, 188. Question on this chart: could either entry have been the descending trend line? I don't know what that means. So I don't know what that question means. So I don't know how to answer that. Let me see. Okay, here's another question for Vroom. There appears to be no special volume increase on the pivot breakout. To what extent do you look for volume confirmation? Okay, again, the volume has to be determined after the fact. If it's breaking out intraday, you may not have the volume. So, all right, but if let's just say it breaks out and there's no volume, well, I'm not going to sell it because of that. Dave, you're going to sell the stock, it breaks out, but you don't get confirming volume. What does that mean to you? And does that raise your antennas, or how do you handle the situation if you don't get the volume?
Yeah, if you don't get the volume, but the stock is acting fine, then I would stay with it. Maybe you don't keep on buying it, but unless it does something wrong, then you can go ahead and stay with it. Sometimes you see stocks that all of a sudden, a few days after the exact buy point, you start getting the volume. But
that's right. Yeah, and again, if I don't see the volume, my antennas do go up a little bit. I'm going to watch it a little more carefully here, and if it starts coming in and the volume's picking up on the downside, now you've got a low volume out, high volume in situation, and I might cut it before it hits the stop, and especially if that's coupled with other violations. So it's the weight of evidence that you're looking at, not just that one particular volume marker. Let's see. All right, I got some questions on stop losses. I'm going to keep those for when we get into risk management. So how do you handle a situation which a stock following a breakout, it goes up for a few days, but with all bad closes? Is it a confirmation or a violation? So let's just say the stock goes up 3 days, and all 3 days it closes on its low, but each close or each higher high is higher than the previous day. That is not a violation in my book.
It's not a violation, but it's not a good sign.
It's not the greatest
especially
sign.
If it's 3 days in a row.
Right.
You gotta be careful. I mean, I would maybe even move up your stop point if that's happening, because it should, if it's going through a proper pivot, it should get going and go fast.
Right. And, again, it would raise my awareness, and I would start watching it more carefully to look for other violations. But that's not a violation in itself. It's just not the greatest price action because, again, you didn't get, you had 3 bad closes. So, that would definitely be something that would be a red flag. But again, the price is up. Now, if the volume was real heavy too, that also would enhance the negativity of that, because now that's a sign of some churning. So you really, you'd have to take it day by day and see how that unfolds. So again, that's why, hypotheticals, I like to, see the exact situation, but page 204. Well, actually, no, wait a minute. Where is that question? Oh, here it is. I'm sorry. Page 199. Why is there only 3 contractions and it's not 6? Well, because there's not 6 contractions. I mean, that's the reason, and I'll show you. So the first pullback is here. Now, it doesn't make a lower low until it rallies all the way back here, right? It peaks, and then it goes to here. So now that's your next lowest point, and then it rallies back again, right? It rallies back here, and now it pulls back right here. right? And then you get that final right here. You actually get a little tiny. So you actually have 4 as a 4T there. So it's 3 contractions, 4 T's, 4 pullbacks. There's no other way to count that. That's I invented this, so that's the way I would count it. So that's the way I would do it. If you have another way, you feel free to show me. Let's see. David mentioned that the best stocks are the ones that he has a profit in right away. Therefore, would you sell some if not at a profit on the first day you buy?
No, because you got to give the stock. Sometimes the stock starts breaking out, but the overall market is not good, and you're down 50 cents on it, or you're down just a percent. You got to give the stocks. Set your stop, honor those stops, and give the stock room, because sometimes, and I do it too, I'm trying to be so precise. I'm trying to get it down to that last little penny, but the markets aren't that precise sometimes. There can be a lot of volatility, so give it some room and just don't kick it out because you're down on the first day.
Yeah, I know, especially when you first start doing this, and some people are more, they like to quantify things more than others. Some people have a more of an artistic sort of way of thinking, and some people are more black and white. But I know a lot of times you want black and white answers. So if it does this, do I do that? Fortunately, that's not the way it all works with stock trading. Thank God, because if it did, like I said before, you'd be able to quantify everything, put it into a computer, and there'd be no opportunity. So the thing is that you're looking at the excuse me, sorry, you're looking at the weight of evidence. And why would you want to be at a profit right away? Like, how would that change how you handled the stock? Let's put it that way. So let's just say, the stock breaks out and boom, 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 3 days in a row, you're up, and you're up 10% right off the hop. They're all good closes. I would treat that trade a little bit differently than if the stock maybe went up one day, came back in on heavier volume, couldn't really rally very well, and really didn't do much, because the stock that moved so good and held up so well, I might not be so quick to sell that one now. You see, that stock, or maybe let's say it's at a 15 or 20% profit, where I would normally be selling some and taking some nice easy profit. Well, if it's acting so well, instead of selling half or maybe even selling any of it, I might hold the whole thing or only sell a quarter of it, where I might, under other circumstances, sell half of it or all of it, because it's acting so well. So you're going to have to make these determinations on your own, and these are judgment calls based on the weight of evidence. And again, I'm giving you a lot of things to look at for violations and confirmations, but you're still going to have to make that determination. Now, again, I'm giving you the most common things, the things that to look at that you really are going to give you a very quick answer whether the stock's acting right or not. You don't need to look at a whole lot more. You look at how many days up, the closes, everything that I've shown you and that David and I have talked about. And that's pretty much all you're going to need to know if the stock is acting right. So just get really good at identifying that, and then you'll start to get a feel for whether the stock is acting normal. See, here's a perfect example. You come out here, runs up, comes in. This is natural. Everything's okay here. There's no major violation. Sets up a little tiny little cheat area there. Comes out there, pulls in for a few days, undercuts a previous low. Perfectly natural, ripping right back. Again, if the stock's acting like this, you probably want to give this a little more room with at least part of your position, especially if you're coming out of a bear market. You may be starting a new bull market. This could make a big move. Now you've had 1, 2, 3, 4 natural reactions. The stock's getting extended. You got a really good gain. I mean, you're almost up a double now here. Now you start thinking about selling it. It's made a decent move, but in order to get to that big gain, you're assessing whether you should hold it or not based on how well or how poorly the stock is behaving. Let's see here. So this is page 205, referencing here. If you miss a good VCP entry due to a gap up and plan to enter in natural reaction as in Yelp, what characteristics are you looking for the natural reaction to confirm a valid entry? Look, I'm not even going to get into that because you should be buying it proper in the first place. All right. And that's what you want to get good at. And if you start thinking that way, then you're going to have a whole new set of buy parameters. You're going to be a pullback buyer, and I'm not teaching the pullback buy because that's not the optimal buy point. You shouldn't have to worry about that. Should be buying the grand majority of the stocks at the correct pivot point. So I'm not even going to. I see what you're saying though. After the natural reaction, very simply, the stock turns up from a natural reaction, maybe gets into new high ground. You're using the same exact principles, but you're not going to have a base. It's only going to be several days to a couple weeks. If it's a natural reaction, getting back into new high ground. Sometimes I will buy, I will do that. I will buy a stock if I really think it's a leader or something that's real powerful, but 99.9% of the time, that's not the case. So that would be probably another workshop that I have to do on pullback buys. All right, let's see here. Hold on, I'm sorry. I'm just trying to go through some of these. Do the violations apply the same once you're at a profit and you've maybe even taken some profits off? So, Dave, I mean, you and I are, really sort of the author of these violations. We've been talking about them for years and years and years. I'm looking at the violations, during that first move and then subsequent, looking through that first and second natural reaction usually. But again, if you get a bunch of lower lows on volume, then that's not going to be a good sign no matter where it's coming from. But the question is, Dave, are once you've made a move in the stock, those same violations apply?
You mean where you have higher
lower lows, consecutive lower lows, bad closes?
Oh, yes,
yeah.
They apply wherever you are in an uptrend. If that starts happening, then that's just telling you're getting a lot more supply coming in, and three lower closes, just not. It's telling you that there's probably some institution that's lightening up their position.
Yeah. So again, we're going to get into selling too. We're going to show you the contrast between when you're buying from the buy point and when you're selling when the stock's extended, and you're going to see some interesting things where we sort of just flip the script, and it's like I said, pretty interesting. But we're going to get to that. That's a whole nother section. All right, a few more questions, and then we're going to wrap this up. We're closing in on close to 2 hours now. When David mentioned to be careful when a stock is wedging up, we covered wedging in detail. I'm not going to get into wedging now. Let's see. A lot of these are the same questions. Looking how far to look back for supply. That's why I'm taking so long here. A lot of these are duplicates. So I mean, a lot of duplicate questions. What makes a pivot failure? Just simply falling below the pivot. So for instance, you break out here, and I'll show you right here. Let me just get this little tool that draws a box. So right here, you have your buy point right here, and it breaks out. So if you were to then reverse and get below that low there of the pivot, right in here, well, then that would be a pivot failure, and a base failure would be below this low. And a base failure is obviously more ominous than a pivot failure. So once it breaks out, you want it to hold the low of the pivot. I mean, that's the optimal situation. Doesn't always work that way. Sometimes you'll shake out the pivot and you'll actually tighten up, and it'll just have to build more, or it'll completely fail. But again, you'll have to assess and take a look and see if there's violations there, and assess the quality of or the lack of quality of the move. All right, one or two more here. Let's see. Are the odds of success on a reset after a base failure higher than the original setup before the base failure? And are the odds of success higher after a base failure reset versus a pivot failure reset? So I know as a matter of fact, Snap today, Mark, you were looking at that, and we pointed it out on the platform as a failure reset sort of setup. Just anecdotally, have you any evidence of whether one's more a higher probability than another?
Yeah, I wouldn't have a hard number on whether one's higher probability, but I would say, as a general rule, if something has put in a failure reset and shaken people out, I'm potentially more interested in it. Hopefully I wasn't a part of the first shakeout, but that's
Right.
not always the case because it tells me that just some of the weak hands have been rinsed out. So there's, the stock is liable to go now. But I don't have hard numbers on it, and I don't think of it that way. To me, it's more does it meet the criteria again? Whether it's because a perfect base isn't going to have a failure pivot. Ideally, it's just going to take off. So yeah, I don't like I said, I don't have stats on it. But
yeah, and that was my next comment was going to be how many. What would you say the percentage of your trades are either pivot or base failure resets?
Low percentage.
Yeah, me too.
I mean, less than 10%, maybe.
Right. That very, and again, like here, you could call this a reset. Right. I'm going to show you an example here. You can call this a reset, but really, it's just building the base. You might have just been in early. And to you, it's a reset.
Short. Yeah, it's too short there on that first one, I probably wouldn't have been buying. Right? Yeah, I see what you're saying, though. Exactly.
Yeah, a lot of times, that first breakout is off of a base that, in hindsight, wasn't even really that great, and then it just gets better, and you realize, what? Actually, this is where the base really completed. This is something that I learned from something that William O'Neill said many years ago. When I went to a seminar and saw David Ryan and William O'Neill back in the 80s, where there was I think 20 people in the room. It was really, nobody knew who O'Neill was. Investors Business Daily. It was, if you asked 100 traders or 100 brokers, what's Investors Business Daily or who is William O'Neill, you'd be lucky if 2 people knew. And William O'Neill said, and this really struck me. I left there with an amazing amount of confidence from hearing this statement. He said that when everything's right, if your analysis is right and everything is set up properly, the market, the stock, the pivot point, it's going to be a success every single time. The only time it's not going to be successful is when there's something wrong. There's something you missed, whether it's in the market, whether it's in the earnings and the setup. You missed something that if it didn't work, then your analysis was faulty. And that was empowering to me. I felt like, okay, so the opportunity is there. It's there. And if you get it right, this works. So I left there thinking, I got to learn how to do this, because if I get really good at this, there's an incredible opportunity there. That's how I read that. That's what that meant to me. And I've found that is absolutely true, that you'll go back and you'll see that, all right, well, you missed something, something 99% of the time, the base was faulty. The market was in a correction. You previously had a whole bunch of losers. You shouldn't even been probably trading at that point because you just had a string of losers. Like, you'll always find that when the conditions are ripe, it's like, when the banana's ripe enough, that peel just comes off so easily. It almost falls off the banana. And we just saw that, right, Mark? We just saw that just recently, several months back. I mean, trading was just so easy, and Mark has several $1 million more to prove it. It was really of what I call an easy dollar environment. When you get those easy dollar environments, everything works and things just happen to everything just happens the way it's supposed to. But you have to get good at learning how to identify that.
And I would add that's why it's so important to do a post analysis on your trades, because it's amazing when you look back on the stocks that you lost money on. You look at it and you go, oh my gosh, what in the world was I thinking?
That's right.
How did I miss that? What was I doing? I mean, it's so obvious that this stock was prone to failure, but that's what's important. So you study those mistakes and don't make them again.
Yes, and also study the winners that worked out, and go back and look at the big winners each year and see the ones that worked out, and you'll be saying the exact same thing and the opposite and going, how did I miss that? Oh my Lord, how did I miss that? It was so obvious. Well, it wasn't obvious at the time for what maybe your skill level wasn't at at the development that it needed to be at that time, or you were so nervous about the market, and you were watching the headlines and CNBC and everything is the end of the world, and you got convinced that you shouldn't be buying then, or whatever the reason is. But all that clarity will come in later on when you take a look at those charts, and you've got this basis for exactly where you should have been buying. So do that, do that post analysis.
I would just make a point too that the post analysis of your own trading will give you more confidence because it's stuff you did. We were studying, some of Mark's old charts or stocks that, we've traded, but studying the stuff that you have done will give you the confidence to say, well, this is a tendency I have, and this is how I'm going to fix it. Because you'll start to see where, maybe where your strong suit is and where your weak suit is, and that will sort of give you the ammunition you need to get better.
Yeah, you lived through it. You have emotions attached in there. You'll remember specific times and dates within that chart and what you were thinking and feeling, and it's amazing on how it comes to life. Now, we're gonna wrap this up, but I just want to say one last thing that is really just to me, it just hits me as so cool here, and it's just a great honor for me. We've got essentially the three generations here. We've got David Ryan, who I went to his and O'Neill's seminar back in the early 80s, I think it was 85, 86, whenever it was, somewhere in that neighborhood. In the mid 80s, I went to go see David Ryan. He won the U.S. Investing Championship. I left that seminar wanting to win the U.S. Investing Championship. He was in Market Wizards. I ended up getting asked to be in Market Wizards, and I won the U.S. Investing Championship. Then years and decades later, I have a seminar, and Mark comes to my seminar. And Mark Ritchie comes, and he puts down these huge returns, has a great 10-year run, comes to my very first seminar, and now 10 years later, he's working with me, and we're all three working together, and we're sharing all this knowledge, and now you're the next person that's going to be the next leg in this generational passing of the torch. So isn't that really neat? And we've got all these people that are in the U.S. Investing Championship now. It's so great. Norm started it up again. It was a great contest. At one time, it was like the premier contest. To win the U.S. Investing Championship was just to be among the best of the best. The Marty Schwartzes, Paul Tudor Jones, David Ryan, William O'Neill, all these people, all these big names that everybody either won the U.S. Investing Championship or had their protege win the U.S. Investing Championship. So again, this is just, passing the torch along, passing the torch. And this is going to go on and on and on and on. This isn't going to stop with me or Mark or David. It's going to go on. This story is going to continue. So it's really great. So I'm going to wrap it up here. I think that this has been, we've exhausted a lot of questions in these few days of Q&A. There's not much more that how much further we can take this without, you're going to have experience at this point. I think we've illuminated every little nook and cranny. But again, we still have not gone through the selling. We've got so much more that's going to happen on Saturday and Sunday, and then live trading on Monday. So you'll have, more questions, and we'll answer questions during the live trading day. We have the whole entire day that we're live, and we're going to have all kinds of fun things going on there too. So we're going to wrap it up now. I don't know if Bob, if I maybe caught you sleeping. I don't know. Are you there?
Yep.
So we'll wrap it up. This is going to replay, I think, tomorrow. Is that right, Bob? We're going to replay this?
Yep. 10:30.
So we're going to replay it, so people in different time zones can also get the benefit of the Q&A, and then we'll see everybody on Saturday, 9 a.m. Eastern time. We'll re-pick up for the day 3 of the curriculum. Dave, thank you. Mark,
Yes.
Thank you.
Always a pleasure.
Yep, great time.
Yep, appreciate it, and we'll talk to you guys later.
And that will wrap up the evening with the question and answer session for part 2 of the 2020 Master Trader Program Super Performance Workshop. I'm Bob Weissman. Again, as Mark mentioned, in your email that I sent out to you, check your emails. If you haven't looked in a spam folder, if you don't think you have it, it may be there, and we will reconvene and replay this tomorrow morning, Friday. That is Eastern Time at 10:30 a.m. And if we don't see you tomorrow, then that means we will see you Saturday morning, bright and early, 9 a.m. Eastern Standard Time for the first presentation of the day 3. The second session replay of Saturday, day 3, will be on Saturday, 6 p.m. Eastern Standard Time. With that said, wish you all good night and a lot of information to absorb. And certainly we did get through pages and pages of answers tonight. So thanks to all the presenters and the speakers for their information. With that, I wish you a good night or a good day, depending upon where you are, and we'll see you soon.